The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the October issue of Digging into the BI. This is where your chapter volunteers and friends from the Maryland, DC, and Virginia area talk about some of the stocks that are in the latest issue of Better Investing. And there are the 4 stocks we're going to be looking at on your slide, and we'll just go on to the next slide. Cheryl? So who are we? We're Better Investing. We're an investment education organization. We focus on long-term investing. And those highlights in blue, they're links. So if you're not a member of Better Investing, you can click on those and find out more information. And if you are a member and you want to share this information with a non-BI member, you're more than welcome to it. And let's go to the next slide. So this is our standard disclaimer. We're doing this for educational purposes. All of us that are making these presentations are volunteers. So there's no investment recommendation. Even if we say something's a buy, we may even have it in our personal portfolio. The fact is that in Better Investing, we strongly recommend that you do your own research and come to your own conclusions on these things. But we are not promoting any particular websites or products or services other than the fact that we're all members of Better Investing. Next slide. So this is a little new. Some people are always sending questions in the question box about how to navigate through GoToWebinar. So I decided to change it a little bit. Over on the right-hand side, that sort of blackened thing, that's your control panel. And you can open and close that by the arrow if you want to. If you see where I have the green circles up at the top and bottom, if you grab that with your mouse, you can move that around if you want it in a different location on your screen. And by default, your microphone is muted. We will unmute during question time, and you can always raise your hand during question time or type in a question, as you can see there. And it's easier if you actually pull it out, if you see where that purple box is, and write to us. And you can either send it privately to one of us or to all of us. Let's go to the next slide. Up at the top, again, there's a quick 4-minute video for people that are having trouble with GoToWebinar that I found on YouTube. But we generally get questions about people saying they're having trouble hearing us. Since everyone else can hear each other, then the audio problem is probably local on your computer. And these are ways to be able to check to see where your computer settings are to take a look at. And then finally, look at the bottom. There are 5 handouts, the presentation deck here, as well as the 4 completed SSGs. And go ahead and download it, and you're welcome to share those things. Next slide. So the other thing is that sometimes it's hard to read things. So if you go up at the top and you see where one is zoom, if you want to make things bigger, you can zoom things there. And if you, even though you have the handouts, if you wanted to take a screenshot of a particular thing to help remind yourself, click on 2 and you will get a screenshot, and it will download into wherever your default is for images that come into your computer. Next slide. So why are we doing this? We're doing it because we want to be able to help out people that are either beginners, uncertain with their judgments, or they just flat out like talking about stocks. We're trying to show you the best practices as espoused by Better Investing. And again, this is a joint program from the Maryland chapter and the DC regional chapter. We have 3 model clubs, and we'll talk about our Visit a Club program. But it's just welcoming people that are in the Mid-Atlantic. Let's go to the next slide. So in just over an hour, we're going to do 4 presentations. We're going to do the stock to study, the undervalued feature, and 2 more. And I think this month we're finding them from stock screens. But anyway, that's really it. Let's go to the next slide. So you can always find these things in advance by going to the main page where it's highlighted in yellow and go to Welcome to Better Investing and look under About Us, or you can scroll all the way down to the bottom in the black where it's About Us, and you will be able to see, if we go to the next slide, where this stuff is. So there's the notice. It told us what the stock to studies were, and this was about 6 weeks or so ago. And you can already see they have the November issue up there where they're looking at Medtronic and DR Horton. Next slide, please. All right, to not miss any of these future announcements, this is the steps to be able to make sure that you can get the email information on stuff that's going on in your community. And let's go to the next slide right away. So this is a way to do it. If you see where that red arrow is, that will take you to the local chapter news. If you live in the Maryland chapter, it'll default to the Maryland chapter, and obviously the other one will go to the DC chapter. But before you hit that save changes, a big red circle there, go up to the top where it's highlighted in yellow and look at the weekly newsletter, and we'll show that on the next slide. So this is something that comes from headquarters. It's exclusive for people that are members, and it highlights some of the stuff that's going on in the better investing community that is part of your membership. So they have things like Stock Up and Ticker Talk to take a look at those things and upcoming events. You can see we're getting to the end of the year, so there's stuff for your club treasurer to take a look at. Comes out on the close of business on Thursday, and if you signed up for it and you're not getting it, you may want to check your spam filter. Next slide. And we also have our Facebook pages for the two chapters. You don't have to be a BI member. We don't have much activity there, but we're trying to be able to get some stuff there. I've been putting things to the Maryland chapter, to the DC regional chapter on this. But please, you can share that with other folks if they want to see us. Next slide. Cheryl, this one's all you.
All right, we at the DC chapter, we have a monthly book discussion called Money Matters. It was on the second Tuesday of each month. It is now, for the month of October, moved to the third Tuesday of each month. So there's information on here that is going to tell you in the events for the DC chapter what the book is for this month, as well as the future. Back to you, Kevin.
Thank you. Okay, and Brian, you're up to tell us all about what's going on in the Maryland chapter.
Yes, the stock analysis class will be held on 2 Saturdays, October 16th and October 30th. In that, we cover 3 companies and a stock comparison guide in the same industry. And register through the College of Southern Maryland. You can get the information online at send an email to me, or you can go on the Maryland chapter website. Thank you.
Thank you. And all of our emails are at the end of the slide, so you can find that. Kent, tell us all about the Maryland Model Investment.
The MMIC. Hi, this is Kent, and the Maryland chapter hosts the Maryland Model Investment Club. We meet virtually at this point on Saturday, this coming Saturday, the 9th, from 10:30 to 12:30-ish. And this week, our stock study will be Lockheed Martin, as well as SSG in action on Disney. And then our education is a little different than what we've got here due to some other commitments. Our education this month is succession planning for an investment club, experience in action. So that's what the Maryland Model Investment Club is doing. Next.
Okay, and Brian, back to you, and tell us about your club and what's going on in Culver County where you live.
Oh, I'm a member of the Blue Point Investment Club. It started around 1998. It's got 16 partners. Meets on the 3rd Wednesday of the month from 7 to 9. We've been doing it virtually. Most of the time this summer we try to get together in an open venue, and so we can at least see each other. And the education stock study, those are to be determined just before the meeting. And again, there's my email if you have any questions.
Thank you. And now to you, Richard.
Hi, this is Rich. I'm the Vice President of the Montgomery County Model Club. We started in 2016. We currently have 8 partners. We meet on the 3rd Wednesday of every month at the Rockville Library, but since COVID, we've been meeting virtually. We hope to be back to the library classrooms soon. Our education this month is going to be extra graph lines on the SSG, and the stock to study is Boston Beer. Our point of contact is shown as Ken Williams. Back to you.
Thank you, Rich. And all of these in here, if you see the GoToMeeting that's in the blue underline, that's hyperlink, so you can be able to click straight on your PDF on that and be able to get to it. No, Bhaskar, tell us about McNova.
Good evening, everyone. I'm Bhaskar Arumugam, one of the partners in the Model Investment Club of Northern Virginia. This is started in 2008, and we have 13 partners. We will be meeting next Tuesday, the second Tuesday of the month. This is a new that we are doing it beginning this month. We usually meet 7 to 9 p.m. in the Tyson Spimmet Library in Falls Church, but we have been doing online for all these past 1.5 years during the pandemic. The education segment, we will be talking about different types of brokerage trades. Stock to study will be picked eventually before the next meeting. The point of contact is Cheryl, and her email is provided. Back to you, Kevin.
Thank you. Let's go to the next slide. And Cheryl, tell us about the Visit a Club.
Well, there are two ways to look at that term visit a club. Right now on the BI website, it's mainly talking about clubs that wish to have visitors, that have maybe openings in their club due to attrition, and so are looking for new members. And if you fill out, each club can fill out paperwork and then be listed on the website for either the Maryland or the DC regional chapter, depending on where their club is located. The other way I like to look at the Visit a Club is having clubs in each of our areas contact us, and they're looking for a director maybe to come and provide some education or talk about some ways to go through the SSG within a short period of time. And we are glad to do that. We are definitely want clubs to contact us and let us know what would best serve their club members. And then we will arrange probably at this point in time for a virtual meeting and see what happens. Back to you, Kevin.
Thank you. And I also see someone, thank you, Cheryl. I also see someone has their hand raised. We'll take care of the hand raising at the end. If you want to write a question in there, we'll be able to respond to you underneath it. But let's get back to this. This is the latest issue of Better Investing. And again, it hasn't come to through my mailbox yet here in Baltimore, but it does come on out usually up to 2 weeks in advance of the meeting of the month. And I see it. I can see it on my computer, my laptop, smartphone. I have it on my tablet. Let's go to the next slide. So this is how you can be able to find this. So if you see the green arrow when you're at the Learning Center in BI Magazine, if you go to Better Investing Magazine for mobile devices, it will show you how to be able to get that information on your tablet or your smartphone or on your computer. Well, actually, it will show up on your computer anyway, but the others would help. And then the red arrow is anytime we have one of these featured stocks, they usually say there's additional reports. And if you click there, that's where you will find those things. Let's go to the next slide. So we feature one column from the current magazine, and this one caught my eye. It's the Clubhouse. It sort of helps investment clubs. And it talks about, we ran into this in MCMC at the beginning of the year, how you use appreciated stocks to fund withdrawals. So if you have someone who's leaving your club, this is a great example of it, and you can be able to see some of the real benefits that can go with it. So read this article, and if you have any follow-ups, you can always reach any of us in our emails, and most of us are pretty knowledgeable on club accounting. Next slide. Okay, so we're ready to do our first two presentations in core. So why don't we just go straight to Bhaskar and go to the next slide.
All right, good evening, everyone. This is again, the stock that I'm going to talk is about PepsiCo. Ticker symbol is PEP. This was mentioned as an undervalued stock in the October issue. You can also find this in the ticker heat map. If you have access to the SSG Plus or Core SSG, you should be able to see it. Next slide, please. So This is the article that was in the magazine as it came. Like Kevin mentioned, if you have access to the electronic format, you should be able to read it. This is highlighted as an undervalued stock. What it really means is a 20% increase in investment value, market price appreciation plus dividends within the 18 to 24 months. There are a lot of information about this company in this magazine. They are covering all about PepsiCo and why they think it is an undervalued stock. Next slide, please. So this is a quick analysis tool which I usually do to understand the company's quality. This was developed by Kosh Meshri and it was published in 1990. It is still an effective tool for us to understand before even going deep into a stock. So it is categorizing, it is just looking at, it uses the value line basically, and you just punch in all the values from the value line, and it gives you a score based on which you can decide whether it is even worth to proceed further with a deeper analysis or not. Based on my analysis using my July value line data, this turns out to be a below average company, mainly because of the sales growth rate. It's not consistent for the past 5 years, and the earnings per share is not consistent for the past 5 years. Because of that, it could not it got the below average score. But other than that, all the other points are reasonable, especially they are very strong in the dividends. They have been very increasing dividends for the past several years. This is a very large company, as anybody knows, and over $70 billion turnover. This comes under the beverages. If you remember, in January, Coca-Cola was done under this as a stock to study. It is a comparison. If you have done a study on that, you can do a close comparison with that. Next slide, please. So there are a lot of information. It has basically the company has like most recently there are like 23 different types of products. Even I didn't even know that. I was going through that, and there 50% of the profit margin comes from Frito-Lay's and Quaker products, which is also something to note. In 1965, they merged with Frito-Lay, marketer of the salty snacks. The majority of the income or profit margin comes from that. So in 1980s and the 90s, they introduced or acquired 9 beverage lines, both carbonated and carbonated, non-carbonated. They also introduced the overseas expansion efforts. So management has expanded the lineup of the Mountain Dew varieties. There are a lot of acquisitions they made. In the mid-August last year, they partnered with Boston Beer to produce a hard Mountain Dew. It is set to expect the stores in early 2022. So they are expanding their product footprint. Also last March, the energy drink, they introduced like 6 different flavors in the Mountain Dew Rise. In 2020 March, they acquired Rockstar Energy, which is supposed to be a big acquisition for $3.9 billion. In December, in 2018 December, they acquired a SodaStream sparkling water for 3.2. That is another bigger acquisition. They did several 3-for-1 stock splits in 44, 77, 86, and 1990. And also in 2-for-1 in 1967 and 96. So this is PepsiCo has been paying the cash dividend for 56 consecutive years and has raised the amount annually. That is where their strength is, and it is a very good dividend paying stock for what it is really worth. As you see, they are expanding the product line now, and they are into new partnership with the different companies to expand the product line. That is the reason for the growth of the company. Next slide, please. So this is coming from their quarterly report, and as the company says by themselves, their operating profit margin majority, 46%, are coming from Frito-Lay, 6% from the Quaker products, and then only the beverages, and international categories, they are all covering in many places. Net revenue, under the net revenue category, they still have 26% from Frito-Lay, Quaker products 4%, and the beverages in North America is 32%, and the other countries adds up to 30% approximately. Next slide, please. So with that information, I went into CFRA, Value Line, and Morningstar, which are my preferred analysis sites. CFRA had some mentions about this company and is marking as a strong as a buy. CFRA is marking it as a buy, and Morningstar as of August 31st, 2021 price, it is estimating a fair value of 153, and the close at that time was 154. I think now it is slightly lower. Value Line is showing it's a strong A++ company with a price persistence growth of 70% and earnings predictability of 100. So these are factors or guidelines that is giving me to study more. So next slide, please. This is from Morningstar, what the bulls and bears say about this company. They are basically saying it is expanding the product line. Their dominance in the salty snacks, which is the Frito-Lay, and all are underappreciated. They are growing to, they are with a volume share of more than 10 times the largest competitor. The firm benefits from unparalleled unit economics and go-to-market optionality. So on the bear side, some of the things is still they are number 2 compared to Coke, and the pandemic situation is creating less people trying more coffee-related products, and they are avoiding this. And the risks based on the recommendation and target price include lower than expected demand for its beverage and snack food products, unfavorable weather conditions, and increased competition. These are opinions from the analysts on from Morningstar, Value Line, CFRA. Next slide, please. So I went into the SSG. I used the Core SSG for this. Core SSG is a good beginner's tool which walks you through of each and every step in detail. And the education on the right side, if you click, it will give you more details about how to analyze this data, how to read this data. This is one example where the legends, I compared it with Keurig, KDP, Monster Beverage, and Coca-Cola. I wanted to show how you compare it with the peers. As you can see, it is we are looking for really up straight sales growth, but it is not up, at least it is straight, consistent. For the past 5 years, the analyst is next 5 years sales estimate, actually it is 2-year sales estimate, is 6.2%, which is the analyst consensus estimate, which comes from Morningstar. I am giving an estimate of 6% for the next 5-year sales growth, which gives a projection of 99 million. Next slide, please. I did not.
5 minutes, Bhaskar.
I'm sorry.
5 minutes.
All right. So the core under the earnings per share, I did a comparison, and again the estimate is 7.7 from the analyst. I am choosing the 6%, which is the same as the sales, which brings to earnings per share of $7.92. Next slide, please. So I'm just capturing some of the screenshots in the Core SSG, but if you go through each and every step, you would understand how the whole SSG is built. I am just going to my next judgment screen, which is the forecast for high price. If, as you can see, the last 5 years of high PE, it is spanning between 14 and 35, and I am using a high PE of 27.5. For the 27.5, the high stock price forecast comes to $217.90. The closing price as of October 1st is $150.90. Next slide, please. And again, this is another judgment of how is my low price forecast looks like. Again, I am using the same low price and using my judgment for the past 5 years. I'm using 22 as my low PE, which brings $130.20. Next slide, please. So ultimately, what is the potential gain versus loss using the zoning that I have chose? It comes as you can buy the stock anywhere between $130 and $150.90 to get an upside downside ratio gain to loss of 3.2 to 1. Next slide. So the ultimate compounded total return based on this is if you would end up getting annual return of 10.2 with a potential annualized price appreciation of 7.6%. Next slide. So this is a comparative study. If you really wanted to look at a challenge with this stock, these are again some of the stocks that float around in the better investing community. This is a screenshot from Manifest Investing, which is another website which is using the better investing principles, and they analyze using the quality and the par ratio. So if you take a look, you can see Boston Beer is quality is 97 with 18% projected return, and Monster Beverage is another one which has 96 with 8.2. So if you are interested, you can do another comparative study with these, and you can make a good decisions on PepsiCo. Next slide. Conclusion.
2 minutes.
Pepsi is a large size steady growth company, and it's a well-managed company. As you can see, it is a very long historical company which has been paying very good dividend. Its current PE indicated it might be fully priced. It is trading above its historic 5-year average PE. If you want to get 3.1 and 15% total returns, you can buy it up to $121.30. It is a worthy candidate for a watch list, and if it is something that is of interest, you can add it to your watch list. Thank you so much.
Thank you, Bhaskar. As always, very good job. Okay, I'm up next, and we're going to be talking about OLLI's bargain outlet holdings. And I found this through a predefined screen called Roster of Quality. Let's go to the next slide. So it's a predefined screen, so you find it in the middle. It's under Roster Quality. And if you click on that question mark, you'll be able to see what the criteria is. And actually, when I did this and selected it in early September, it was in the Roster Quality. But when I went to make these slides this weekend, it wasn't. So it sort of drifted out. But it's still in the ticker heat map, which you have to have SSG plus. So it's one of the top 100 looked at stocks in the better investing community. Let's go to the next slide. So here's what I tend to do is that it's in the S&P 400. You can read all the other things. What I found was kind of interesting when they looked at the stores, as you see where I have Semi-Lovely and it's highlighted in blue, that's again a hyperlink, and we'll take you to a glossary they have on the OLLI's website, and they describe their stores as Semi-Lovely. Most people would describe them as Spartan. In other words, they're not spending a lot of money on frou-frou things. This is sort of a treasure hunt, and they try to find things at a really cheap thing. What they'll do is they'll buy stuff that's that like Walmart, Costco, and other large retailers are trying to get rid of because they want to rotate their stuff, and they'll immediately buy it for pennies on the dollar and then sell it to you, marking it up, and it's still a great discount. And they're looking to get to about a little over 1,000 stores. Let's go to the next slide. So it doesn't really have a lot of coverage in the communities that we look at, because if you look at the CFRA in the upper right, it has a strong sell, but that's a straight computer algorithm. It's no analyst has taken a look at it. And the same in the lower left where you see Morningstar. Anytime you see a Q rating, it also is a quantitative measure. But you can still use this information. You just have to add a little bit more critical stuff. But we have a strong sell and a hold on both of these things. And let's go to the next slide. And so this is the OLLI's and Value Line report. And when this was done in July, it was at 89 and change. And on the close of business this Friday was just short of 60. So the question you have to ask yourself, at least I do, is this a falling knife? And if you don't know what a falling knife is, click on that link and we'll give you a definition. But generally, here's the thing. Now, Value Line does not have these buy, hold, and sells like CFRA and Morningstar do, but they generally have pretty favorable commentary on Ollie's. You know, the earnings and sales and earnings are looking good. Price appreciation is better than the median in Value Line. The balance sheet is good. The commentary is positive. So we're going to have to put on our thinking cap and try to figure this one out. So let's go to the next slide. So what I do is I'll use the research tabs in your online tools. And I went to go take a look at some of the key financials in Yahoo. Now I could go through a whole bunch of them, but I sort of stuck with just a couple of them there. The stock equity has doubled in 3 years. The free cash flow has doubled in 3 years. So, I mean, and there are a host of others that I looked at and it was just like, this looks like it's a pretty strong company financially. So I don't have to necessarily worry about it and the like. So then on this, in the bottom part, I went to the company website and looked at their, their webcast on their latest earnings that was done by Goldman Sachs. And I gathered 3 different points that they felt they had a really positive impact because of the stimulus and people coming in. They do acknowledge that the supply chain is going to be a challenge, as it is for all retailers during the pandemic. And they're in the process of hiring a new senior VP to cover that. But here's one thing is that the Ollie's Army, and that's sort of their discount group for frequent users, 80% of all their sales come from people in Ollie's Army. Very interesting. And again, that's a link so you can find that. Let's go to the next slide. So I'll tend to look at a bunch of resources outside of it. Here are all the stuff that's that I found. The 2 I want to focus on is number 3 and number 5, the ones that have red dots next to them. There's a Motley Fool story there. This is classic, this is an infomercial. They have information on Ollie's, but it's designed for you to basically look at and say, let me go buy a Motley Fool's subscription. And a lot of other organizations do this too. They'll give you this and come in there. It doesn't mean that Motley Fool isn't something that I recommend, but just realize that when you see this kind of story that it immediately says, well, get our subscription for this. And it can be any of the people out there. That's a classic case of what's going on. And then the other one at the bottom, Peter Lynch, this is from 93, and he talks about a falling stock. And this is a classic case with Ollie. So if you want to look at a falling stock and understand it, Peter Lynch and his book, One Up on Wall Street, is a great place to look at. Let's go to the next slide. I tend to look at all the different retail competitors by store size, average size, and sales. And obviously, we would not compare Ollie's really to Walmart and Costco. I put it more to just sort of let you see where it sort of fits in the continuum. The problem is that none of them are really in the same area where Ollie's is. The one that is in the lower right-hand side in green. It's called Bargain Hunt. They have 86 stores. The problem is, and it's really a direct competitor, but it's privately held, so we don't have any data on it. What I essentially zeroed in on were Kohl's, Big Lots, and Five Below as best ones, but those are sort of the ones that sort of stood out with me. Let's go to the next slide. So we're doing this in core, but I always like to look at the front side of the SSG to take a look at it, and you'll see up on the top, both Big and Ollie, the 2 on the top, they have these nice steep things from 2019 to 2020, and that's the impact because they were open during COVID. And because the semi-log graph that this is graphed on, it shows a rate of change rather than absolute numbers. As a percentage, they went up really, really high last year, and as a comparison, they're going to drop this year. And that's the reason why you'll see those dots there for those 2 dropping. Conversely, Five Below and Kohl's, KSS, they were not open during the pandemic, and they have this big drop from 19 to 20, and now they're coming back up. But let's go to the next slide, and let's get into this. So the historic sales, what I'm going to do is I swapped out what they had in there and decided to add Kohl's and Five Below. And these are all color-coded to take a look at, but Ollie's is growing at 18%. And again, we'll see the recent quarter, the second red circle down in the bottom, it's a negative 21.4%. Again, it's because the rate of change from they went up really, really high last year. So the measure of it is really tough. And in their webcast that I mentioned earlier, they acknowledge that. And they say, well, look, over the last 2 years, we still have this good, solid growth. So it's a good explanation of what's going on. Next slide. So here we are with the historic earnings. And again, you'll see that KSS and Five Below got really hit by COVID, and Big and Ollie didn't, if you take a look at those things. So again, earnings looked really, really great for Ollie's historically, but if you look at the recent quarter, the stuff that's sort of in that grayish purple down in the bottom, it's got a negative number down there. I think it's negative 66. What happened is that analysts were targeting 57 cents per share in the EPS, and it only hit at 52. That's the squared box there. And as such, the stock really got hammered when that came out in July, or really in late August. Next slide.
5 minutes, Kevin.
Thank you. So the pre-tax profit on sales, I put the red zero line in there so you can see where it is. And again, Ollie's is doing significantly better than anyone else. They're 12.7% pre-tax profit when the industry is only 4%. And that gets back to what I was telling you in terms of their business model. They buy stuff when something like a Walmart or a Costco or anyone else trying to get rid of it, and they buy it at pennies on the dollar, and then they turn around and sell it in their stores, much like a treasure hunt. Next slide. The return on equity here, 14.6 is okay, but it's not as great as the industry average at 17.9. And some of the others are a little bit higher and looking better, like Big Lots. But the thing is that it's a decent return on equity, not enough to sort of throw it out. And if we look at the next slide, it will come into clearer. Is the debt to capital is by far Ollie's has the lowest debt to capital, which makes their return on equity even stronger. And if you don't understand what I'm talking about, there was actually just recently the Rocky Mountain chapter of Better Investing did things on visual analysis. And if you go to that link that I have there, they have one of their guest speakers sort of outlining this if you want to understand debt and return to equity a little bit better. But overall, their debt at debt to capital at 15.3 is significantly less than the industry average, which makes a return on equity even stronger. So I certainly consider that good. And here, the lower number is better, where the other ones we like higher numbers. Next slide. So forecasting the sales. If we look at the historic numbers, you can see that in the upper right for the three ones. I dropped Kohl's from this because I just didn't think it was holding up like the rest of them. I projected, as you see down in the bottom, the second red circle, I'm doing 14% sales as the estimate. The historic average is 18, and the analyst going out 2 years is doing 15. I just think as things start to slow down, it'll be fine, but I think they're still going to have some good store growth. They're growing about 40, 50 stores per year is their projection. Next slide.
2 minutes, Kevin.
Thank you. Next slide. Oh, we are there. Darn, you were. They're so similar. Sorry. Forecast earnings. If you look at this, and this shows up for both Five and Ollie's, is that they have these historic numbers that are really, really high. But if you zero in on just the more recent years, they're much more reasonable. And I think that's where you have to sort of start things to take a look at it. And from those things, I just sort of said, well, let me do 9%. Ollie's management is estimating earnings growth at 7% for the coming, through 2022, or actually in a year from now. So I thought as things start to shape out and they get a little bit better with their supply chain, that number is not too hard to hit based on seeing analysts and the historic numbers are significantly higher. Next slide. So when we look at the high and low PE, I got rid of Big Lots. I think Five and Ollie's are the ones that are the interesting ones. You can see where I estimated my earnings being in the future at 27. The historic is 32. And here's where a Five sort of loses me, is that while it has excellent growth in sales figures, those PEs are significantly higher. They're in the 40 to 80 range. And so you're paying a lot more for this in 5. And if you want to understand more, we had a presentation that Ken Williams did, I think 2-3 months or so ago on Five Below, and he was bullish on it. So you can listen to that or look at, we can get to the set of slides to take a look at it. But that's where I am. Next slide, please. So the low PE, thank you. The historic low PE is 18.5. I thought a 13 would be pretty good. The current PE is 19.8. And when I selected my low price, I'm getting something that's about 66% of the current price. That's a little bit lower. You know, generally we'd maybe look at something in the 70 to 80 range. But I think with some of the cyclicality that goes on with this, it gives me a little bit more range, a little bit more of a margin of safety. So let's go to the next slide. So I get a 3-to-2 upside downside ratio, pretty straightforward. It's in that buy zone, and we go to the next slide. There's no dividend or payout ratio, so everything comes from the earnings growth and PE expansion, and it gets a 15.9% total return. And let's go to our final slide. Our conclusion, it's a steady growth, medium size, well managed, fairly priced, not so much really on sale, but fairly priced. And it's a buy up to 60, so it's about $1 up from where it was, and it could be a candidate to purchase. That is my presentation. Let's move on. And so here are the ones we're going to do for the SSG Plus. And first up will be Richard Aronson. So Richard, take it away.
Okay, thank you, Kevin. So I'm a vice president of Montgomery County Club, and the stock I'll be studying tonight is Malibu Boats. It's listed on the NASDAQ exchange under MBUU. And the way I found the stock was the ticker heat map. Next slide, please. So for those that are not familiar with the heat map, I found originally LCI Industries, which was in the consumer cyclical market. I was looking for small and medium-sized companies, and when I started researching LCII, I found a competitor in the recreational vehicle was MBUU. So I continued the search for other competitors in the recreational market. And the next slide, please. So I found, other than Malibu Boats and LCI, I also found Fox Factory Holdings and Polaris. They're all small to medium-sized companies as defined by Better Investing. They're in boats with Malibu Boats. They manufacture parts for RVs and other recreational vehicles. On the right, you can see some snapshots of the front side of the SSG, showing the sales, pre-tax profit, and earnings slopes. On Malibu Boats, LCI Industries, and Fox Factory, they tend to be up straight and pretty parallel. Polaris, on the other hand, is an example of a downward trend in pre-tax profit and earnings. So I decided to eliminate Polaris based on a poor visual SSG moving forward. Next slide, please. I also compared them using Morningstar data based on their star rating and whether they were under, over, or fairly valued. You can see that Polaris has already been eliminated by visual analysis of the SSG. Fox Factory rated 1 star and a narrow moat, but was overvalued at 39%. So I decided to eliminate Fox Factory as a comparison and focus on Malibu Boats and LCI Industries. Next slide, please. So the final comparison I used was a Better Investing stock comparison guide. I looked at LCI Industries, Malibu Boats, and I also included Fox Factory. I did not include any judgments at this point in time. I just wanted to look at historical information to get a fair comparison across the 3 stocks. And I compared historical sales and earnings growth, quality of management, relative value, and present yield. And Malibu Boats led in or matched in 8 of the categories. So my stock that I continued to study was Malibu Boats. Next slide, please. So I selected it based on the SSG, the Morningstar rating, and the SCG standings, and eliminated the competition based on each of those evaluations shown. Next slide, please. So how does Malibu Boats make money? Next slide. They build recreational boats for people into the boating sport. They have 5 different brands that they market under for different, for fishing, for water skiing, and for pleasure craft. Next slide, please. So they're the leading designer, manufacturer, and marketer of power boats under the 5 brands that I described. They have a #1 market share in the US, 32% versus their closest competitor, about 15%. And they've been expanding their market in fiberglass outboard fishing boat market, which we'll talk a little bit about later on. Net sales, volume, and income, and average net sales per unit have been generally increasing from 2016 to 2020, with a slight downtick in 2020. I want to point out that the average net sales per unit is an important aspect of their growth. They pride themselves in having their customers come back every 2 or 3 years to upgrade their boats and to move into a higher price category. So they're constantly striving to meet customer demand and improve the dollars per sale. Next slide, please. This is the fiscal year 21 results. Net sales volume and net sales per unit were all up. You notice net sales increased 12% again, so they continued in 2021 to improve their net sales per unit. And the comparison mix on their boating is they've doubled their saltwater fishing boats volume from 2020 to 2021. Next slide, please. So Malibu's growth strategy is, as I mentioned, the ability to meet customer preferences. They've patented a number of devices. Their most popular ones are a swim step on the rear deck of the boat and a surf platform to make the best surf wave, which is important to their customers. They're also trying to move into new market areas with new products, new acquisitions through their 350 dealers. Important to them is to improve their margins. They've expanded production capacity for their boats, and they're now building 25% of their boats in-house, which has allowed them to expand on their pre-tax profit percentages. They also have been very good in making strategic acquisitions. In the last 5 years, according to Morningstar, they've achieved 33% additional sales growth because of their acquisitions. Next slide, please. So let's talk about SSG judgments. Next slide. So this is the front side of the SSG. What's noted here is some anomalies in the data in 2014 and 2015. MBUU went public in February 2014, and they used their prior earnings to pay down debt, which caused their loss in earnings per share in 2014. They also refinanced again in 2015, raising their debt to capital to 152%, but they've been very successful in lowering that debt consistently through 2021 with an average debt to capital of 37% over the last 5 years. Next slide, please.
5 minutes.
This is the historical data, which I just wanted to highlight. The sales growth historically has been 23%, earnings growth 31%, pre-tax profit 15%. Return on equity has been excellent, 37%. And debt to capital, as I mentioned, was 37%, downward trend with an industry average of 60%. Next slide. Sales judgment. I looked at a number of sources, and Morningstar was showing a 5-year compound annual growth rate of 12.7%, which was similar to value line, 13.5%. And I tried to stay conservative and chose 12.7%, also because value line estimated sales in the 2024 to 2026 timeframe at 1,600 million, and a 12.7% sales growth rate estimated the sales in 2026 at 1,685 million. So I was pleased with that, staying with that percentage. Next slide. Earnings growth rate. I also looked at a number of sources. I ended up choosing preferred procedure because I had more control on the parameters that go into preferred procedure, that namely pre-tax profit, the tax rate, and the number of shares outstanding. Next slide. So this is an example of the preferred procedure for that stock. You can see I estimated the pre-tax profit based on the value line, net margin, and tax rate shown there, 13.7% and 22% respectively, yielding a percent pre-tax profit of 17.5%, which also was in line with what Malibu and Morningstar were expecting, higher production efficiencies due to their vertical integration and production facilities. Also, that my judgment estimated the sales in 2026 at $8.38 a share, and value line was projecting 2024 to 2026 $8.75. So I was happy with that number. Next slide. This is the backside of the SSG. I made some minor adjustments to get rid of anomalies. The biggest change was the average high PE went from 21 to 18. Next slide, please. And this is section 4 of the SSG high-low price. I estimated the high price of 18 times the earnings per share of $8.38, yielded a high price of $151 a share, which compares favorably with the value line projection for the high price of a high of 160. So again, I was happy with that estimate. The low price, I used 20% below the current price of $70 to yield an estimated low price of 55. I also looked at the low PE method, which was $46, but that was 34% below the current price, which is also equal to the low in 2021. So I kept it to $55 low price estimate. Next slide. So the risk reward information is upside downside ratio is 5.2 to 1, even though I try to remain extremely conservative, and I put it in the buy region. Total return based on the high PE is 16.5%. And it remains a buy up to $79. Currently, it closed at 71 and change today. Next slide, please. So in conclusion, Malibu is a small-sized company with a high historical growth rate. Has been on an upward trend in sales year over year for the last 10 years. It's very well managed based on return on equity, percent pre-tax profit, and it's trading at a 5-year average PE and well below its average high PE of 18.7. It's a buy up to 79, and its current price is actually 71.37 today. And I think it's a candidate for purchase. Thank you.
Thank you very much, Richard. Great job as your first one. Let's bring over Brian and bring us home with Lockheed.
Okay, thanks, Kevin. Good evening. I'm Brian Koenig, a volunteer of the Maryland chapter, where I'm in charge of education programs. I'm also a member of the Better Investing Volunteer Training Committee. Tonight, I'll be covering Lockheed Martin Corporation, symbol LMT. It's featured in the October 2021 BI magazine as a stock to study. And as a reminder, the goal of the stock to study is doubling in investment value in 5 years. And Lockheed stock ranked number 78 in the 2020 top 200 and was owned by an estimated 113 clubs. And I do own Lockheed for my personal portfolio. Next slide. From humble beginnings in 1912, 2 aircraft companies began, the Martin Company in August and Lockheed in December. They remained competitors for about 50 years. 1961, Martin merged with American Marietta and strayed from primarily aircraft into chemicals and household products. However, in the mid-80s, it divested the non-aerospace operations, becoming well known for their space projects in energy, electronics, communications, and information systems. In 1995, during a consolidation in the defense industry, Lockheed merged with Martin Marietta to form Lockheed Martin Corporation, which today is the world's largest developer and manufacturer of defense, security, and intelligence products. Next slide. It has 4 main business operating segments. The aeronautics is 40% of the company. It makes F-16, F-22, and F-35 fighters, C-130 transport aircraft, and other things like that. The missile and fire control, 17%, provides missiles and their targeting systems. Some examples of that are the Patriot Advanced Capability, or PAC-3, for air defense, and the Terminal High Altitude Area Defense, THAAD, for ballistic missile protection from, let's say, something coming from North Korea. Rotary and mission systems, 25%. It's military and commercial helicopters, nearshore or littoral combat ships, missile systems, mission systems for surface ships and submarines, and rotary and fixed wing aircraft such as the Black Hawk, Seahawk helicopters, and Aegis Fleet Defense Missile Systems. And finally, space, 18%. The Orion multi-purpose crew spacecraft for carrying crews for NASA's planned 2024 lunar mission. Lockheed Martin derived its revenues, 74% from the U.S. government, 65% from defense alone, and the other 26% is from foreign governments and commercial customers. Competitors, General Dynamics, L3Harris Technologies, Northrop Grumman. Next slide. Some recent headlines. Lockheed signed a $1.1 billion contract to supply 16 F-35s for the next year. A little bit below what the industry was, but it's still recovering from COVID. The announcement ensures a production predictability, which is very enhancing for long-term airplane projects. However, during the COVID, Lockheed continued to keep money flowing to the subcontractors so that the subcontractors could keep their production lines open and retain qualified personnel. So that should work for them when the production line at Lockheed comes back online. An acquisition of Aerojet Rocketdyne is progressing. Aerojet produces rocket engines that Lockheed uses in its operating segments. And finally, by increasing their dividend for 19 years, currently to $2.80, the Motley Fool thinks this defense giant might be the market's best dividend stock. Next slide. Of note in the company information box that Lockheed is in the industrial sector, aerospace and defense industry, and Lockheed is a large company having FY 2020 sales of over $65 billion. Next slide. Additional company information was noted in the ticker heat map. Lockheed's green color indicates it's considered a favorable company by those completing SSGs. There have been 385 studies completed with historic sales growth rate of about 4%, historic earnings per share of about 12%. I also looked under the, down on the bottom there, the research tab, in order to review the Better Investing member sentiment results. There were 332 studies done in the past 90 days showing member sentiment for sales growth of about 5% and earnings per share of about 5.5%. Next slide. On value line, we can see the Lockheed's current price, the black dot on the right hand, yellow highlighted, is below the value line indicated by the dashed lines, and it's also below the 2025 target price range of 420 to 515 is indicated over there on the right hand side. The value line analyst, Ian Gendler, as you can see below, Lockheed has been underperforming the broader market, but has meaningful potential appreciation. Next slide. Here I've calculated the compound annual growth rates for earnings per share from 2020 to 2025 of 6.3%, and for sales, 4.7%. The estimated sales for 2025 of $33.30 and the sales of $81.5 billion will be entered in line 2025 on the detailed estimates tab. Next slide. As you can see down at the bottom, those numbers have been entered there. Next slide. Here on the SSG graph, the detailed estimate values are shown in the filled in circles for sales and earnings per share on the 2025 calendar line. you will note that there are 2 diamonds past these values. Since I elected to use a quarter for my projection starting point, you will note 2 things. First, that there is a thickened circle indicates the latest quarter, fiscal year 2021, quarter 2 data point. If you look up on between 20 and 21, you'll see those, the 2 ones that have the thickened lines. And the second, that clear over to the right, there's a diamond that's to the right of the 5-year estimated value that we talked about from the previous slide. The diamond information in the call out boxes are the values shown below in the forecast percent in the 5-year earnings per or estimated sections. A 4% growth rate for sales to 81,289 and a 6% earnings per share growth rate resulted in a 5-year estimate of $34.41 for the connector. And it's been called a connector because it's the only value from the SSG front side that's used in any calculations on the SSG backside. Some other information that I've included on there was a dividend, shares outstanding, total debt, and the you can see that the dividend looks pretty nice, and the compound annual growth rate is 9% over that period of time. Next slide.
5 minutes, Brian.
Okay, evaluating management, you'll see that the trends are all positive for the pre-tax profit on sales, return on equity, total debt, and the one at the bottom is looks especially good because the debt to capital went from 90% before the purchase of Sikorsky to it's now below 70%. So management is doing a good job. Next question, next slide. Okay, for section 3, what we're interested there in, the first thing I want you to call your attention to is column C, the second line down with the $6.64 of earnings during the purchase of Sikorsky. This earning drop caused the high and low PE to increase significantly and be considered outliers and removed. The remaining PE values resulted in a high PE in bottom of column D of 19.7, low PE of column E of 13.1. These resulted in a 5-year average PE of 16.4. And this value is what will be used in calculating the forecasted high price on the next slide. Before leaving this slide, it should be noted that at the current price of $345.10 and a trailing 12-month earnings per share of $25.71, that reflects a current PE of 13.4. This results in a relative value with the current PE divided by the 5-year PE of 0.82, which is indicating an undervalued condition. Next slide. So the 16.4 that I mentioned in the average high PE, the estimated earnings from the side 1, the connector 3441 gives me a 564 high price. The low prices you can look at, I decided to take 80% of the current price and came out with $282 for the low price. Next slide. What you see here is that with the forecast low price of 282, forecast high price of 564 resulted in a buy zone from 282 to 352.6. The current price of 345 results in an upside downside ratio of 3.5 to 1. And with the potential market price appreciation over the next 5 years going from 345 to 564 would be 63.5% if the price increased that way. Down at the bottom of the box, you can see that there's a summary of what we just talked about. Next slide. For the 5-year potential, I selected the compound annual return based on a more conservative forecast average PE, which is a red box at the bottom. Annualized price appreciation of 8.6%. Average yield 2.6%, which gives an annualized rate of return of 11.2%. If you look over in the summary box, there's some more information about the high PE, average PE, and some other information for later on to look at. Next slide. In order to get an idea of how Lockheed's stock price was trending along with the relative strength index, I selected big charts from the research tab. The top chart shows the stock price has been decreasing since about April or May. It should also be noted that the last 2 price bars clear over on the right may be showing a leveling off or maybe the beginning of a price increase. The analysis is supported by the relative strength index values beginning in an upward trend where the red arrow shows you down on the bottom of the right-hand chart. Next slide.
2 minutes, Brian, 2 minutes.
Oh, I hope I can make it through this in 2 minutes. Lockheed Martin is a large size, mature growth company. It's an excellent, well-managed company. It's fairly priced with the relative value of 0.82. It offers a consistent dividend growth. It's a buy up to $352. And Lockheed is a worthy candidate for an industrial sector company for either an initial purchase or for accumulating shares to help balance a portfolio. I think that's it.
Thank you, Brian. As always, a great job. In fact, you're so good, we probably ought to have you teach an SSG class. How's that?
Maybe I'll help somebody else do that in October.
Very good. Let's go to the next slide. Brian's one of the doing that. So we went through a lot of stocks very quickly, and we know your head can be spinning. So again, you have the handouts and you have our completed SSGs and the like. But let's sort of do this as a follow-up. Let's go to the next slide, and we're going to talk about sort of like how they fit in the life cycle. This comes from T. Rowe Price. Corporations like people go through life cycles. In this, that's a quote from it. But if we go to the next slide on slide 103, this is sort of the image that a lot of us see. We have it in the SSG handbook. And what I want us to do is now all of us presenters sort of talk about where you think yours fits in there. And I'll go first. Ollie's, as you see where it is, it's sort of at the tail end of an explosive growth, and it can sit in that spot to mature growth for a very long time. But I think it's really well positioned. It's got a niche market that no one else is really in, and they seem to have some numbers that can be able to support this. So I think that's where it sort of sits there. Brian, you want to tell us why you selected that location for Lockheed Martin?
Yeah, with an annualized price appreciation of 8.6%, Lockheed's growth rate is above the Better Investing acceptable growth rate for large-sized companies of 5 to 7%. So I think it's above the explosive growth, but it's nowhere near a stabilization section yet. So that's why I chose that.
Okay, thank you. And Bhaskar, I sort of took unilateral decision, but is that a right spot for PepsiCo, or do you think it ought to be moved left or right on there? Bhaskar, are you there?
I'm not seeing him on the list here.
Okay. All right. He may have. He's been a busy guy, so he could have dropped out. But that's sort of where it sort of fits in there. Let's go straight to Malibu Boats, and Richard, tell us all about where you think if that's the right spot for Malibu Boat.
I think it's in a good spot. Malibu has pretty explosive growth, averaging 23% over the last 10 years. But I'm looking at a slowdown in the sales growth to about 12, 13%. I think over the next 10 years, it's going to mature in that region of 12, 10% growth. So right now it's at the tail end of explosive growth, moving into mature growth.
Thank you. And so, yeah, PepsiCo is basically, he had 6% sales and 6% earnings going forward. That's about right. I mean, this is a humongous company, PepsiCo. And again, they have, what is it, like half of their performance comes from snack foods, and the other half is from carbonated beverages and other drinks. So it seems to still have a lot of strong growth, as he pointed out. It consistently is raising its dividends, and it's looking pretty good. Let's go to the next slide. So if you like some of this stuff, we're all volunteers, and we would certainly love to have you participate with us, either in this event or in any of the other things. So if you saw this being pretty good, go ahead and become a spokesperson for better investing with your friends and family, and either get them into your own club or get yourself involved as well. Let's go to the next slide. So you can volunteer. This is the only way this thing goes, is that we all do it. But while you're volunteering, you do learn new skills, and you can hone your own investing skills, usually doing stuff like these. The more you do SSGs and the more you do presentations, the better you get at doing this. And it's just like if you were in a garden club, you'd like to hang out with other gardeners. Here, if you like investing, hang out with other people that like to talk about investing. let's go to the next slide. And I think before we do this, let's put up our poll. It's about time for our poll question.
Alrighty.
And that will give me time to look at the hand raise and stuff. But this is your time to vote.
Whoops. Where did my poll question just disappeared? Hang on one second. I'll tell you what. Oh, there it is. Never mind. We're gonna manage and that and launch.
So you can, this is free. We won't know who you voted for, but go ahead and vote. And once we're done with this, we'll open up for some questions. I see we have a couple or hand raise. Okay, we've got 80% of you voting. We got a dead heat. Let's see, we're at 84. Let's see if we can get above 85. We're holding off. We're holding off. I think let's close it.
Alrighty. And share.
All right, so you can be able to see Malibu boats in your first run for all the marbles. Richard, you won with Malibu boats, and you know, pretty close. Lockheed Martin came right in, right behind it, and bringing up the rear are Pepsi and Ollie's. No
What do
one
I
likes
win?
my Ollie's. You get to be able to come back and do this again.
Okay, fair enough.
So Kevin, we've got a couple of questions plus a hand raise.
You want to take us through that?
Yeah, sure. Richard asks, what effect is the slowdown of the supply chain having on these companies? And he wants to ask Richard in particular, what effect is the chip shortage having on the sales and growth for Malibu boats? So supply chain for these companies slow down and chip shortage.
Well, based on the 2021 quarters, they've been doing very well. They've accelerated their sales and earnings. So it doesn't seem to have affected it very much that I can tell. They just finished their quarter in August of 2021. Was their fiscal year end. So we won't know until another 3 months if there's been a downturn in the 2022 first quarter.
Okay. Anybody else have any comments on their companies with respect to the slowdown of the supply chains?
Well, that was actually in one of my slides with Ollie's, is that they recognize it. I mean, some of this stuff is coming from China, and there's logistical things of getting stuff out because of COVID, and just having enough bodies to be able to move either in transport in trucks, or to be able to get them on shipping containers, or to be able to get them offloaded at docks. So they recognize that, and that's the reason why they're really, you know, Ollie's is sort of focusing on that, and that's not unique to Ollie's. That's all of the people that are dealing in retail and getting their stuff to them.
Yeah.
And for Lockheed Martin,
Go ahead there, Brian.
okay, yeah, for Lockheed Martin, the production line for the F-35, they had to redesign it a little bit to get the people farther apart, which slowed down the throughput of the F-35s, which caused the subcontractors to have too much product. However, what Lockheed did was they used their own money, as I mentioned, to keep the subcontractors to keep fully employed as much as they could, to keep the people on staff, so that when the COVID is over and they get back to full rate production of around 30 a year, 26 a year, they're going to have the people there in order to do it, so they won't have to try and start new subcontractors. That's how they handled it.
Good. Let's see. Whoops, Richard
Sorry,
had
just Just a moment, just before you put that up, Cheryl, can you put up the slide that has our email addresses? So in case if anyone wants to reach out to us. And
That's the
then
one I
back
have
to you,
up.
Kent. Oh, I can't see it. That's my fault. I don't see it. I just see your overall screen. Anyway, Kent, go back to you.
Yeah. So Richard Bishop, you had your hand raised, and we got lots of Richards on the line. And wanted to know if you wanted to ask anything. Your microphone is unmuted if you wanted to ask something. Give you a few seconds to. Okay. All right, moving on. Let's see, Alfred asks, for Lockheed Martin, any speculation on increase to sales because of the recent Russian missile launches? Brian, I think that's for you.
Well, I know that there are a couple companies that are working on hypersonic missiles for from the United States. I'm not so I'm sure that the way that it works, that there are probably 2 or 3 companies that are given some money in order to try and do some research that'll eventually turn into a product down the road. I'm not sure that that's an adequate answer. That's all I can think of right now.
That's a pretty good answer. Any other questions or comments from folks? Feel free to raise your hand or.
And if you raise your hand, we'll unmute you so you can talk.
Oh, yeah, there's that too, yeah.
Sounds like we pretty much have run out of questions. Did we get them all? It looks like we have.
Oh, Richard, got another question from another Richard. Who can teach about using the heat map?
If we go, let's see.
Kevin?
Put up the heat map. It pretty much describes what it is.
Why don't, Cheryl, can we go back to, I think Richard's second page would be like slide 64, and you can talk about it, Richard?
Sure.
Let me get out of easiest. And go here.
Oh, you could have just hit 6-4 enter and it would have gone right to that slide.
Okay, well, I'm already here, so hang on.
That's fine.
Here we go.
There it is. Okay, so the heat map is the top 100 stocks that have been studied by members and submitted in the past 90 days. So the size of the box indicates the number of studies out of the top 100 studies. And the color, the greener it is, the more favorable the study. The more red it is, the less favorable the stock is. And also, if you click on a live link, it'll tell you how many studies and some other information about the stock study itself.
And if we go to here, I'll find this slide number for you. But in the middle of Brian's presentation, he showed it with Lockheed Martin.
Okay.
Let's see.
Slide,
it would
slide
be
89.
Oops.
There you
89.
go. And
Yeah.
Brian, why don't you talk on slide 89 about this, or since go ahead, Brian.
Yeah, the size of the box is Richard said, had to do with the number of studies. In this case, there were 385. Apple, I think, had over 1,300 on the The other one that he had over on the left-hand side, I think, was a little over 1,000. So that the number of studies that are done determines the size of the box. And as Richard said, the color of the box has to do with whether they're favorable or unfavorable. In this case, Fastenal is, the SSGs are not favorable. For Lockheed, they were. And then it has the sector, the industry, and the historical sales and earnings per share from the studies that were done there, which is a little bit different than the Better Investing Member Sentiment. It's a different number of SSGs done, and so those numbers will be a little bit different.
And I want to point out that this is strictly based on the results of each individual's stock study. And so it's based on individuals' judgments as well, and should not be the only criteria that you look at. You want to look at other criteria, not just whether or not they made the heat map or not. Just be sure to, to expand your research beyond that.
Any other questions, Kent?
Well, the question cloud is still, oh, no, it's still fading in and out.
Kent said he had
I see one.
his brother and had
Yeah. So we have another one from Richard. Can smaller, medium-sized companies be considered a blue chip? How about Brian? You want to take that one? Can small and medium-sized companies be considered a blue chip?
I would say possibly if the definition of blue chip means it's a large stabilized company, and I'd use something like I don't know, before the COVID I probably could have come up with a better answer that would be used as a core holding. I don't know, let's use Berkshire Hathaway. That might be considered a blue chip, although that's a group of companies that you would use for a core holding and then build around it. A small or mid-sized company being a blue chip, that would, the small, it kind of implies that they are intending to grow. I suppose if they're a small company and they reach their growth potential based on their product, they're not going to grow much over the next few years because they're just going to keep that product. I don't know, maybe in the drug industry where they could maybe have one drug that's going to be around for a long time. Nobody else wants to step into that area, and it's going to have a steady income for a long period of time. That might qualify under that way of doing it, but most of the time I would say probably not. It probably needs to be, it would be a large company that has been around for a long time and has a slow growth, 2 or 3%, maybe a couple percent on a dividend. That'd be my guess.
Yeah. And when I usually, Richard, I'll look at stuff like Investopedia. It has no relationship to Better Investing. It's just a source I like to use. I view as credible. It's a privately held company and the like, but they do have several links in there. Again, we as better investors don't necessarily look at blue chip, but what you're looking for, I think, with a blue chip would be someone who has consistent sales and earnings growth. And that's the reason why we in better investing, we look for, let's find up, straight, and parallel. I think all of us talked about that in one shape or form about our presentations and the like, but that's the way I would look at it. Kent, any more questions?
Kent had to go. He got a call from his brother. Oh, back. Okay.
Go ahead, Kent. Do you have anything?
Yeah, I don't see anything. I do see that as you pointed out, Ed Rodriguez came back with blue chip company is a huge company with an excellent reputation. One of the other things that you'll find out there on Investopedia is that it's a multinational firm. If you think of companies like Coca-Cola or PepsiCo or Disney, those are considered blue chip companies. And you might even consider Starbucks and McDonald's a blue chip as well.
But we wouldn't consider Ollie's discount a blue chip because it's not nationwide and it's not well known. So
that's true.
Anyway, anyway, I think that's it. We've got everything done at the 8:15 mark, and we've just been taking questions. But we also want to respect your time. And again, if we go to if you have any follow-up questions, if we put up slide 106, that will have our emails. And again, download those presentations, and you'll be able to see everything. But thank you again. And next month, November 1st, we're already looking at our next stocks. It's going to be Medtronic is a stock to study. DR Horton and Home Building is up there. I'm going to be doing Take Two Interactive, and Jonathan is just about ready to decide on his. And once we get that, we'll send out a notice to everyone. But see us on November 1st. There are our emails for all of us here. Thank you very much, and continue to invest. Thank you all.
Good night.
Good night, everybody.
Good night.